Certainly don't take my advice because, you know, as Richard said, I mean, we come at things from a different angle. But yeah, I mean, the CE is the market that I know. You know, the herd has been in Poland, Czech Republic, Slovakia. Those markets may continue to do quite well. But as I mentioned, Hungary and Romania are definitely worth taking a look. And I think, you know, despite all of the political difficulties, Russia and Turkey remain interesting, particularly Russia. I think there's really room for development. We work with a number of clients doing lots of development in Russia, out in the regions. There are a lot of cities with 1 million people and plus needing shopping centers, needing good offices. You know, so if people can, if banks can manage the risk aspect of it, and we'll see how the sanctions affect the economy, but you know, here too in Russia there's a fairly robust domestic market as well, so it's not entirely dependent at all, you know, on Western money, and we've seen a number of transactions continue. So I think that at least in that part of the world, that's where I would look.
Great. I'm getting signals to say we need to be brief now. I can see that. It's a subtle signal, but I can see it. So, James, briefly.
So very briefly, I mean, we would look at a risk-adjusted book overall. So, dare I say it, this is a fairly small number in our overall book that we'll be looking at. But right now, we've invested heavily in the UK. We'll continue in that area, in Ireland and the other main jurisdictions. But I think our big focus for my 500 million would be in Spain, and that's our target area. Okay, good. Thank you, Anthony.
From my perspective, I've always played the niches. I'd stick with the niches, and I would say stick with smaller loans on a whole loan basis in the UK, and maybe in Europe start looking at doing some higher loan to values, but on a very strict senior basis, again, on the smaller side. So probably split the pot into two components. Okay, good. Thank you. Christoph?
I'd say if you're looking for double-digit returns, you're better off going into value-added direct investments. So I would view debt as certainly below that in terms of the return spectrum, much more defensive investment. And so stick to whole loans, and I would go for an element of liquidity, so probably the main markets in Europe, Germany, France, the UK. I would advise you to go with the smaller ticket sizes as well. Probably 10 to 50 million is a sweet spot. Okay, great. Norbert?
Again, I'm the banker here on the panel, so a bit more conservative. But I mentioned earlier that, again, I think a portfolio view is definitely important, whatever size you want to invest. Debt or equity, both interesting. There are several niches or asset classes mentioned. I totally agree with that. I personally like the idea to be at the slightly more value-add side, because I think there are the returns definitely maybe the best at the moment.
Great.
I think two areas that we don't do that probably are very profitable is sub-performing or non-performing, and this is, you know, the play from sub-performing becoming performing. So there's value add there in the sense of, so if you're buying loans. And development. If you're going to be anywhere in the cycle, if you're going to be doing development, now is the time versus 3 years or 4 years from now, because there's just no supply coming online almost everywhere. And you know, if you're going to do it, get it early in the cycle rather than later in the cycle.
Great. Thank you very much to the panel for a very interesting discussion. Thank you for attending, and enjoy the rest of the fair. Thank you.